Welcome back, traders and investors, to Benzinga's pre-market info show brought to you by OptionsHouse. We are on with David Ristau, president and founder of the Oxen Group. David, how you doing today?
Great. Thank you for having me on. Thanks, guys.
Dennis, you want to give a shout out
Pretty
to
well.
David?
Doing
David?
pretty well, except for this bearish market that we're starting to look to
Uh-oh.
have.
Are you? Joel's been on
no,
here at the show all morning with this bearish theme going on here. He said he was talking a few days ago. He's got this whole triple top, the 1810 area on the S&P futures is the whole triple top theme, and he's been preaching bearish. Are you bearish too?
um, I was listening to the show before, so I thought that. No, I'm not too bearish actually. I don't see any reason why we're gonna see any taper next week. There's not a lot of conclusive data that I think is and you got kind of a lame duck with Ben Bernanke. So I think they are actually just using this as an opportunity to buy some stuff a little bit cheaper, and it's off to the races again next week, probably for another month. So
What would make
that's
you
what I
turn? What
think
would
right now.
make you turn bearish? Well, first of all, what's your favorite indicator? I'd like to follow the S&P 500 futures. What's your favorite indicator, and what would make you turn bearish?
Um, I look at a lot of stuff. We use a lot of different indicators. We look at a lot of economic data. We're looking at a lot of charts and doing a lot of technical analysis on those charts, looking for different key support lines. So kind of using a combination of both fundamental and technical. And I think for me, the level that I would look at for the S&P 500 would probably be maybe 1750 again. I know that's quite a drop still from there, but I don't think until you get below that line, you're really in a bearish market. I think you're just kind of having a little bit of a correction. You're seeing some profits being taken off the table, and some lack of buyer interest. And I think the economic data has been somewhat decent enough to support the market. I mean, there's a lot of conversation like, okay, are we overvalued in the market? And there's really not a lot of. I think you look at the S&P 500 PE ratio, and it's nothing. If it's not over 20 or anything, it's nothing overvalued. And so there's really maybe tech is a little bit overvalued. But yeah, I don't see a lot of things out there that are saying to me right now, hey, this is a market that's primed for a big correction. I think you have a lot of things lining up actually for a really good year next year. You've got kind of Europe showing some strength again, a little bit of a rebound there. China's starting to pick up again, and I think we're starting to see some pickup here as well. And so I mean, if that's about to happen, then how could we have a bearish market next year? So just a kind of a combination of a lot of things.
I think a lot of people are still, you hear market structural issues and you hear high frequency trading, and then you hear, obviously, we went through the financial crisis there 5 years ago, and a lot of people are just scared of this market. And a lot of people are definitely underinvested. And now it's funny, you can look here, and a lot of people actually are pretty ticked off because some people really, got shaken out during the financial crisis and sold stock down near the lows. Now we're up here at all-time highs, and people are they just don't trust the markets like they used to. And I think that's why you see every time this pulls back, now it's starting to go the other way where people are like, man, I need to get some exposure to the
Yeah.
stock market because I don't have it anymore. And it seems like every time we pull back 2-3%, people are coming in with their buying shoes on again. Do you think that trend just continues there, David?
Yeah, I totally agree. I'll use my mother as a perfect example because she's like an ultra conservative investor, and she hasn't touched the market since the crisis, and has been hitting me up lately asking me if it's time to get back in again. And so I
Asking
mean, I
you for
think that
money?
she's
Is your mom
just
been asking you for money?
no, I don't think that. I think she just was looking for a little assurance, and and so I think she's kind of just sort of a microcosm of a lot of people out there that didn't trust the market and just see, wow, it's just doing so well, and maybe feel a little bit better about the economy than they did 12 months ago or even 24 months ago, and so I think those things are lining up. I do think the market, though, has priced in a lot of that coming back into it at this point, but yet not probably enough yet still. So,
Okay, that 1750 level you gave then, that was basis the S&P 500 cash, correct? Not the
yes,
futures?
yes, Right.
Okay.
Yeah.
Okay. All right. That kind of coin. I mean, I got that 1748 level I mentioned was the low on November 13th
Yep. That's exact.
basis. Yeah,
Right. That's
basis
the
the
exact same line.
yeah December contract. So you got started at the beginning of the worst financial crisis since the
Yeah.
Great Depression. Okay, and it taught you that the preservation of capital is the most important thing to any investor. Okay. And so here we are.
Great.
We're at all-time highs in the market. We've had a little bit of pullback. Are you putting on any hedges? Are you taking do you ever take profits? Are you just kind of like a Warren Buffett kind of investor, just buy and hold forever, or preservation of
um,
capital? Are you putting your theory into action at all?
so we do quite a few different things with our clients. We're in short term, we're in options, we're in the long term, and so we kind of think differently about each kind of sort of class of assets that we're working with at different points in times. But more generally, I'm still pretty bullish. I just every time over the past 12, 18 months that I've really thought, okay, this might be a turn for us. I've just been wrong. So it's just sort of hard to bet against the market right now. I do think, what we're doing is we're saying, okay, we're in these different positions right now, or different options, or things like that, and let's be conservative now. Let's not, we don't need to overdo. We've had such a great year. So we're using a lot of stop losses that are, and we keep raising those over time. And then we have been adding some different hedges on things that have been fundamentally weak while we've had a lot of strength. So things like gold, we've been pretty bearish on, and some undervalued equities that have not done very well over the last couple months. Those are things that we've looked at for some hedges. Like I think my favorite one has been, and I'm not going to say the name right, Akamai Technologies, AKM has been sort of one of my favorite bearish hedges over the last couple months, just because of how weak it's been. Eastman Chemical is another one that we've been using for a hedge as well.
So when you're saying use these for a hedge, these bearish hedges, you're shorting these stocks? Is that what's happening?
No, we do. I'll use bear call spreads for those. We use options mostly for all of our hedging, and
Okay.
so we're taking those positions, and we're going to dedicate just a small pool of money to do some bear call spreads, to write those options. I find that that's just a great way for me to. Because even if Eastman Chemical rises a little bit, or Akamai does, okay, this is still in a pretty bearish trend. Akamai has been,
Right.
especially, and that I'm still going to be able. My hedge is still going to work, and I'm not going to have to worry about I'm short the stock and it went up 10% or something like that. I could still be correct in my bear call spread if that were to happen. So.
Now you mentioned
So
gold. You mentioned gold there
yeah,
just briefly. We're down 25 points here again on gold, the
yeah,
gold futures
yeah.
today. So we're getting slaughtered in it. You mentioned gold as a hedge. Do you buy gold as a hedge? Because gold is obviously usually supposed to be, anyways, a natural hedge in this portfolio. Hasn't worked well for obviously a while
Right.
here. But are you like looking at
Something
buying
like
gold here?
the inverse hedge. I would not want to buy gold at
So you're
all.
bearish gold too. Okay.
Yeah, because I don't see a lot of reasons to be in gold. I mean, okay, you've got equities just
Right.
continuing to outshine, and you want to be obviously you want to chase the yield, or investors typically do chase the yield, so they're going to want to be in equities, and they're going to move their money. If they were in gold before, they're going to move their money to equities, and at the same time there's not a lot of gold was kind of propped up by, okay, we've got this quantitative easing coming in, we've got a lot of free cash coming in, that's going to help bring the yield down in bonds. Therefore, let's transfer from bonds to gold for some of your fixed income investors. And now that's going in the reverse way. Now that QE looks like it's probably going to be ending. I mean, inevitably it has to end, so there you lose a little bit of value there as well on the fundamental side. And then I think it's just one of those momentum sort of things. Just gold seems to kind of just find a trend and just sort of stick with it for quite a long time. And so I think it's going to take something significant, like another bear market probably, to sort of pull it back out of its current trend. And I just don't see it having a lot of upside in the next probably 12 months, though.
Okay, so you work, your focus, I see is stocks, ETFs, option spreads, and whatnot. So are
Hmm.
you not, not holding individual equities that much per se? I mean, if you're, bullish a stock, Apple or something like that, do you go and look to play it through an option spread, or do you
Um,
outright own many equities?
yeah, we have a portfolio that follows, just equities, and it's more long term. And then we do have another portfolio that just trades equities in a more short term sort of swing trading way. Yeah, so we do a combination of that, and then we also have a couple options portfolios as well. So we sort of have kind of run the gamut there, and I like that personally because that allows me a lot of exposure to a lot of different types of trading and investing. So I'm okay, I like, these companies, these 10 companies over the long term. And then, I can use those companies for some, more short term options trading, option spreads and things like that. And then I can also trade them in the short term as well. And so we kind of start from the fundamental side of things. We do a lot of equity research, a lot of, we call it equity analytics at the Option Group. And from there, we go and we can use those companies for long term investing. Companies that are great long-term investments are also going to make obviously great short-term trades as well a lot of times, and then they're also great for option spreads. So it kind of works in all three ways.
Okay, so
Um, yeah,
do you have defined models that you follow, and you wait for the stocks to fit the criteria in your models and then act on them? Or I mean, are
yeah.
strict programs that you've written, and algorithms and things like that?
No, no algorithms or anything. We use so yeah, we're using really not basic, but more a little bit more advanced like financial analysis and projections. So we're looking at companies and we're understanding their business, and then using current models that are out there as far as company projections and other models that might be from other analysts, and putting that into like DCF analysis, and then we can, from there, from just kind of cash flow, we'll be able to sort of mine out like a 12-month or 24-month price target. Then we can take that price target, we compare that to the company. That gives us a really good sense of where we are in comparison to what we think the company should be priced at, given those projections. And then from there, we can sort of understand, okay, this is a company, there's a lot of upside in this company still, or, oh, there's not much upside in this company. That's not something I'm interested in. So people, there's like companies that like, people are always asking me on my site, like, okay, do I like Tesla, or something like that, or, you know, last year did I like Salesforce.com, and I would always say, that's a great trading vehicle, and sure, you can probably make some money trading it right now, but coming from a standpoint of I'm looking at a value, valuing out the company's business, I don't see a lot of potential in that name, and so I would be more interested in something that I see maybe a little bit undervalued, but has a lot of probably potential growth in the next 5 years. So those kind of those sweet spots that we're looking for, a lot of undervalued names that have potential growth. I could probably throw a few at you guys
Yeah,
if
I
you
was just
mind.
going to actually ask you,
Yeah,
looking
sure.
at all this, what value stocks do you see that are, have the potential for some growth here and are still cheap? Because we've had such a run here. I know I
Hmm.
get this question all the time. People are asking, what can I buy here? Because we've had such a run here, and sometimes you got to sit, and I'm like, I don't know, because everything's run so far already. Is there some stuff there that's still got some value?
Yeah, I think there is. I think at any point in time, in most market conditions, you're always going to find those names where they're just sort of, for whatever reason, they have some value, and then they also have some upside. So one of the companies that I've been really liking for probably 2 years now is Panera Bread, and it's not really an interesting stock or an interesting name. There's not like a whole lot of sexiness to it, obviously, but it's a company that has grown double digits revenue for I think 8 out of the last 10 years. And it actually grew by 5% or more when the recession happened. And it's just a company that just continues to grow very slowly. They're very each year they're opening around almost 100 stores. And we actually did a little bit of analysis on the company, taking a look at geographically. Okay, their most highest saturated store to person ratio is in St. Louis. That's where they got started. And there, I don't remember the exact figure, but I think it's like one store for every about 70,000 people. And so if you project that out to the USA, they have the potential for something like 4,000 stores. Now, obviously, you can't, it doesn't
How
work
many stores
exactly
do they
right.
have now? Do you know where they're at
They only
right
have
now?
1,500 right now.
1,500.
Right. So there's a lot of potential just domestically for this company, and then internationally, they haven't even stepped foot internationally at all.
Right.
They continue to see average checks kind of continuing to rise at their business, and so fundamentally, I really, really like this stock. Well, at the same time, they had sort of a little bit of a weaker earnings report their last report. They went from about 200 to 150. So that's a stock that is starting to build a little bit back into, I think it's about 175, 174 is where it closed yesterday. And so that's a name where I think, okay, that's probably got potential to probably 225 or 250 next year, just based on the growth that it should have again next year if it kind of maintains the same sort of P ratio. Let's see, another name we like. I really like the two apparel manufacturing companies, BFC and PVH.
Yep.
Those are two names I'm really high on. I like their kind of combination of, these are two companies that have a lot of growth. They've been doing a lot of building out their lines a lot and adding a lot more to them. I mean, for example, like BFC was kind of for a long time not really much, didn't have a lot, and now they've got like North Face. They have a ton of jean brands, and so what they're trying to do is kind of adopt this like lifestyle model where we can offer you something for every kind of different activity that you want to do, every different season, and so they've covered their bases, and they have a lot of really solid names in their pipeline, which I think is really good. And so I really like them fundamentally, and it's a stock that just sort of continues to just chug along. And those are sort of the names that we really like. It's not something like, okay, this company's going to grow like 3D Systems or Tesla or anything like that. I'm not really interested in those names because
A lot more risk.
if you catch it at the right time, yeah, you made a ton of money. But is that something you really want to invest into? Is that really something where you want to say, oh, this is where I want to put my hard-earned money that I've made for the last 10 years? I'm not really interested in going into those names because there's so much risk there, and those things have moved so much. Let's see, what else do I have here?
Have you been chasing Twitter around?
No.
That's probably the same. That's probably the one right there. That's the scariest one.
I think obviously it's a really cool company, and I think it's I think they have a place. I don't think they're going away. I think that companies have bought into using them a lot. So you see especially a lot of media companies. It's such a great tool for them, and so I don't see that is going to disappear anytime soon. But actually, I did a little bit of wrote a little bit of report on them the other day. Can't remember the exact stats. I'm trying to see if I can find it real fast. It was this company called T-Poll, and they're an English or British company, I believe, and they did a poll of executives in Europe, asking them about Twitter, and I want to say that here we go. I wanted that right now. Yeah, here we go. So they found that the Twitter's reputation among executives had dropped. So last year, 61% they had seen a 61% drop from 2012 to 2013 in European executives that trusted Twitter as a reputable source, as well as a 40% that respected that brand. And so that's a big problem for them, because if they don't have executives believing in their business or respecting or thinking that this is a business that's really something that we can trust, they're not going to spend money on ads, and that's really, at the end of the day, what's going to drive that business or see it fail. So, well, maybe not fail, but at least not be as profitable as people were expecting. And so that's an issue for them. It's kind of like the same issue that Yelp is kind of going through right now with those fake reviews and sort of, can we trust this business? So that's kind of so that's sort of why I'm not really too much of a fan of Twitter.
Okay. And just real quickly, could you just tell us about your product on MarketFi, marketfi.com?
Oh yeah, sure. Yeah. So MarketFi, I have part of my service that I offer at the auction group on MarketFi, and that is option spread portfolio. And this is a portfolio that is using sort of some of this equity research that I was talking about and some of this fundamental analysis, combining with a little bit of technical analysis as well, and looking for more conservative, low-risk option spread opportunities in a probably 2 to 3 month time frame. So we're looking at companies where we can find that opportunity to maybe write some credit spreads or take on some debit spreads for upside, and we're executing them on things that we like. We do a lot of combinations. We do some in equities, and then we're also using some indexes and some ETFs for different spreads. Sort of using a lot of ETFs and indexes more as hedges, or and also kind of betting with our thesis about the market at any time, and then using equities that we really like from the equity side or the equity analysis side. So I think we've had a lot of success because we've been able to start from that fundamental basis, looking at these companies over a long period of time, and then taking these more conservative bets on them. So just sort of consistently generating income in that way.
Okay, thank you. We've had David Ristau on, president and founder of the Oxen Group. David, I think you will get the award for being our youngest guest on the show. So we will definitely keep your market predictions in mind, and we'd certainly like to have you back on the show.